Hello everyone, welcome to the Managerial Accounting course session 7 in the part 2. In the part 2, I would like to discuss CVP report and contribution margin. The most important part of CVP analysis is the contribution margin. So let's have a look. Okay, so let's, what's the problem? Okay. So the cost volume profit CVP analysis refers to the study of the effects of changes in cost and volume quantity on a company profits. So it's important in the profit planning. So it's a critical factor in the management decisions as setting selling price, determine product mix, and maximizing use of production facilities. So the determining the product mix, we will discuss later on, much more detail in here. So let me use red. Yeah. So this will be discussed in the next part, chapter 6. Yeah. The next chapter. Okay. So the second part, sales mix. Yeah. Sorry, the next. Yeah. Okay. So the CVP is important in profit planning and critical factor in management decision. So how it's work actually? So basically, we know the volume of level of activity and then unit selling price. We need to also know the unit variable cost. We need also total fixed cost, and then we can determine the sales mix. So that's why the name is CVP, cost, variable and fixed cost, volume, pricing, unit selling price. So that's why the name is CVP. Yeah, okay. So, but again, don't forget, we do the calculation is, don't forget on assumption. Recall assumption simplify the model. Yes, assumption make limitation, but without assumption, the model will be very complex. So behavior of both cost and revenue is linear throughout the relevant range of the activity index. Cost can be classified accurately as either variable or fixed cost. So in reality, this is a big problem. Sometimes it's difficult to accurately classify costs. Changes in activity are the only factors that affect cost. So change in activity. All units produced are sold, another important assumption. When more than one type of product is sold, the sales mix will remain constant. Okay, so those are basic assumptions when we want to work in the CVP analysis. Yeah. Okay, so a CVP income statement refers to a statement for internal use. Again, this is managerial accounting. We talk about the internal. So classify costs as fixed and variable. Recall under GAAP, if you recall the financial accounting, you report sales, cost of goods sold, expense, and so on, according to accounting standard or common industry practice. But in the CVP income statement, we just classify costs as fixed and variable because this is internal use and we need for decision making. So we need to report contribution margin in the body of statement. What is the contribution margin? Contribution margin refers to revenue minus variable cost. That's all. Sales minus variable cost per unit. If contribution margin per unit. For total contribution margin, of course, total sales minus total variable costs. At the end, of course, the bottom line, the same net income. We just to reclassify the report to fixed and variable costs because we need for the internal relevant. But at the end, the net income report under financial accounting and managerial accounting should be the same because in the managerial accounting, we just reclassify it. So this is an example. Fargo Electronic Company produce cell phone. There are relevant data for cell phone sold by the company in June 2022. Okay, so let's go. Unit selling price per cell phone 500. Variable cost unit direct material 185, direct labor 100, sales personal commission 15. So the total unit variable cost is 185 plus 100 plus 15, 300. Monthly fixed cost manufacturing overhead $40,000, CEO salary $150,000, sales salary $10,000. So total monthly fixed cost $200,000. Unit sold is 1,600. So the following illustrations compare the traditional GAAP income statement for Fargo. You can see the GAAP we report that you learn in accounting. The panel A, see sales, cost of goods sold, direct material, direct labor, manufacturing overhead, gross profit you get, and then minus any operating expense, you will get the net income. So yes, under managerial accounting, net income will be the same because at the end they are the same, sales also the same. But we need to reclassify this cost, reclassify become variable and fixed, that's all. So in this case, we get the sales $800,000 in the panel B, and then the total variable cost is 480,000. So contribution margin is 800 minus 480,000, so 320,000. Fixed cost total 200,000, so the net income is 320,000 contribution margin minus fixed cost $200,000, so the net income is $120,000. Okay, so this is just reclassifying. I don't think it's no issue. Once you know accounting, it's pretty easy. Just need to reclassify fixed and variable, which is in reality, classifying is the most difficult, sometimes required adjustment. So contribution margin is available to cover fixed costs and to contribute to income. So the result is positive. So equation for unit contribution margin and computation is C. We can calculate contribution margin. So the total, this is the total variable cost, 480,000. But if you 480,000 divided 1,600, you will get 300. Yeah, so the unit selling price, given from the information. 500, unit variable cost is 300. So the unit contribution margin is simple, 500 minus 300, so it's 200,000 here. See, pretty simple. Okay. So in the case of sales 1,000 units, the CVP statement will be zero net income because contribution margin is 200. If the sales is only 1,000, so 200 multiplied 200,000, so the contribution margin will be on sufficient only to cover fixed costs. So the net income will be zero, you can see. Okay. And then if Fargo can sell one more, say 1,001, so the Fargo will start earning profit as much as the contribution margin, because now the total contribution margin is higher, slightly higher than net income, higher $200. Okay. So the contribution margin is show the percentage of each sales dollar available to apply toward fixed cost and profit. So equation of contribution margin ratio and the computation for Fargo will be 200 contribution margin per unit divided 500 selling price. So 200 divided 500, 40% the contribution margin ratio. Okay. So again, assume the Fargo Electronics currently sales are $500,000 in what to know the effect of 100,000 to 100 increase sales. You can do calculation like this. Suppose no change, percent of sales is 40% of contribution. You can see sales variable cost and contribution margin here. So net income is zero. Is with $100,000 increase in sales. So calculate the percentage. So the total is 600,000. So the contribution margin will be 40% of 600,000, 240,000. So given the fixed cost is 200,000, so it will be 40,000. So have a look this one. So that's why percentage of sales is usable, no change, and additional 100,000. This. Yeah. Okay, so what is it? Yeah, okay. So that's the part 3, and then I will continue to the part 4 in the next video. See you, that's the part 2. This is the part 2. And the next part, I will show you in the part 3. See you on part 3. Thank you.